Interest rates are predicted to hit 6% in 2023, and today we're going to look at that data. We're going to see how that's going to impact your loan, and more importantly, exactly what you can do to get around it. So let's begin and look at where essentially the market is and what the predictions are. So back in May this year, an article by the ABC was put out here, and we can see that the RBA's economists assumed that the cash rate would be and would reach 1.75% by the end of 2022 and 2.5% by the end of 2023. And this is really important that we first understand what the predictions are, and then from there we can start to see whether or not it's on track or off track, and more importantly, what we can do and what other information is out there to figure out where likely rates are going to go. So with the current cash rate, we're at the 1.35% mark. So with the last two rate rises, or the cash rate rises I should say, being 0.5%, it begs the question whether or not this forecast is really going to be right, because another 0.4% would mean that we would definitely breach the 1.75% mark. So listening to the RBA's economists or even the governor hasn't proved to be a reliable source of information. There are other feedback mechanisms out there, and one of them is the ASX 30-day interbank cash rate, and it essentially is another way to predict the market. And what we can see here is that in July the prediction was 1.225%, with the cash rate being 1.35%. We can safely say that this is probably a little bit of a better way of predicting where rates will go over the next year or two. Combining that with where the current variable rates are, or current rates in Australia are, and on average it's about 3%. So looking at the spread between the two, we've got about a 1.85, call it a 2% spread. Thinking about that just for a moment, we're also looking at the fixed rates that are currently on offer, and that also can give us a pretty good insight of where the banks expect the rates to be, because ultimately with banks and fixed rates, what they're wanting to do is they're wanting to take margin. That's to say, they're wanting to offer a fixed rate which over the period of the next 2 years will be higher than where the variable rates will ebb and flow. And if they do that correctly, they'll make money. If they don't, they'll lose money. And we can see with NAB, they're predicting a 5.59%. And look, it's not an absolute science, but it's a general feel of where the banks are expecting the market to go. And you can see with ANZ that they're around that 5.5% too. We can see that by the end of this year, adding a 2% buffer on that, we're at about that 5% mark, closer to that 5.5%, 6% by 2023. So realistically, where we're heading is around that 5.5% to 6% interest rate mark by 2023. If you are on a fixed rate, and many people are, more than $500 billion in fixed rates are set to expire over the next 2 years, we really want to make sure that we understand what impact this is going to have on your interest rate. So if we look at, say, I know we've helped a lot of people, and they're on 4-year or 2-year fixed rates as low as 1.99% and even lower in some cases. So if we look at what impact that's going to have on average mortgage, and looking at the average loan amounts that are currently outstanding in the owner-occupied space in New South Wales is about 800,000, Victoria 650, and Queensland 520. We'll have a look at what that will actually mean in way of an increased repayment. So if we take New South Wales, for example, we bring that to around that 800,000 mark, there or thereabouts. And we'll bring that to 30 years with a current interest rate of, say, 2%. If we assume that rates, when you finish, will be about that 5.5% mark, so bring that up to about 3.5%, we can see what that will do in terms of your monthly repayments. So that's quite a increase in your monthly repayments of about $1,600. If we bring that down to Victoria, which is 650, so bring that to 650. It's not 100% accurate. I can't change that over here, but you can see the general gist is about 1,300. And if we bring it back to Queensland, which is around the 500,000 mark, we can see what impact that will have. So about that 1,000 mark. So you can see we're talking big bickies here. It's not small amounts of change, but there are things you can do. So the first thing you'll want to do is you want to talk to your banker or broker and see what negotiation you can do with your current bank. A lot of banks are keen to retain business. For a lot of banks, it costs less money to retain their existing customers than it does to acquire a new one. You might be surprised that in some cases your bank might even throw some money at you to stay and keep loyal. So that'll be your first option. See what your bank can do. If that doesn't work, then talk to a mortgage broker. What they can do is that they can look at other options and other banks out there. There are many banks that are looking and offering cashback bonuses. So if you do refinance, you'll be able to move with no cost at all. And you might even find that you'll be left with surplus once all fees and charges are paid out. One of the things I found quite surprising is actually something that the CEO of Commonwealth Bank, Matt Commons, has said. And he said that homeowners shouldn't be worrying unnecessarily about the pace of interest rate rises over the next 12 months because he's got confidence that his bank's forecast that the cash rate will only rise to half the levels predicted by the market. More importantly, he was saying that they're expecting that the cash rate will only hit 1.35% by the end of this year and normalize to around that 1.6% by about midway through next year. So there's a bit of comfort there in knowing that some of the big banks, and there's a lot riding on it for these big banks, are thinking that it's not going to go as high as what everyone else is expecting it to be. Either way, when rates are rising, it's important that you look at your situation and make sure that it's something you're going to be able to afford both now and in the future. Things you can do right now is looking at your budget and cutting out expenses that are reoccurring, whether it's Netflix or a gym membership. Look at things that can stop right now. One of the things you can do right now is look to switch to a fixed rate. There are limitations with fixed rates, so keep that in mind. Limitations include not necessarily being able to get an offset account, and the ability to pay it back quicker may be reduced. In most cases, it's between $10,000 to $20,000 in additional payments on top of your minimum. So a few things to keep in mind there. And there you have it. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. Our service is free and we help Australia-wide. So thanks for watching, and I'll catch you next time.